Hi everybody, Tom Gile at the Gile Group, bringing you the latest Gile Report. 7% mortgage rates are definitely starting to have a cooling effect on the market. The question is now, where are we headed next? Are we near the top, or is there more to come? In today's Gile Report, we're going to take a look at what's driving current mortgage rates, as well as predictions from the experts of where we're headed next. But first, for a little perspective. Taking a look at Freddie Mac's mortgage survey from last week, mortgage rates on 30-year fixed loans are right about 7%. And remember, mortgage rates tend to follow the 10-year T-bill rate because they're both long-term investment instruments. Some factors that impact the 10-year Treasury yield are inflation, interest rate risk, and investor confidence. Well, if you look at our current marketplace, we definitely are being impacted by all three of these items right now. So let's break it down. Let's take a look at inflation first. September inflation rate was 8.2%. That actually has been trending down since July, where we topped out at 9.1%. But it exceeded the market expectation of 8.1%. As a result, investors are starting to lose confidence in the Fed's ability to tame inflation, and we can see that at what mortgage rates start to do starting late August, early September. They've been continuing a pretty steady run. But I think what's important is, let's break down how inflation is actually measured. And the question is there some relief on the horizon? And I think the answer is yes. This graph shows month over month inflation changes. And what's important to note here is, if we take a look at September, for example, the August to September rate was 0.4%. How inflation is measured is taking a cumulative look at the prior 12 months. So in September, for example, what happens is the tail end of the graph, the 13th month, drops off. So in September, we dropped off 0.4% of September of 2021 and replaced it with 0.4% of September for 2022. There was really no change in the inflation rate. What we're going to see starting in the next couple months is we're going to start dropping off months with higher inflation. So if we continue to have lower month-over-month inflation, say in the 0.1 to 0.4 range, we're going to see the overall inflation rate start to drop as we start dropping off. Like last October, that was 0.9, 0.7, 0.6. So going forward, we should start seeing that overall inflation rate start to drop. So what does all this mean, and what does it mean for the next 6 to 9 months? Well, remember, inflation introduces risk to investors, especially in long-term investments like mortgages and 10-year T-bills. Investors need to make sure that they're going to cover their potential swings in inflation over the long term. As a result, their interest rates go up. Based on actions taken by the Federal Reserve and how inflation is measured and reported, like I showed on the last slide, the expectation is that inflation will continue to decline in Q4 2022 and into 2023. I predict that mortgage rates may stay at their current level, or actually may climb a little bit more in the short term with the Fed's anticipated November rate hike, but they should start to decline later this year and early into 2023. And I'm not alone in this. I recommend you go do a search and study some information from Barry Habib, or contact me for a link to his latest podcast, because he goes over this in some great detail. So, have questions on that? Questions on Barry, obviously contact me, or just questions in general about the housing market, what's going on in your area, reach out, give me a call, send me an email, askgilegroup@gilegroup.com, or check us out on social media. We'd love to hear from you.